Good day to one and all. This is Dr. Sivaraman of iknowindices.com. I'll be presenting now the Tracking the Forex Market Together webinar part 1 on the 14th of August between 8 and 8:45 GMT. So it is a simple market tracking technique and more so an effective trading strategy. So we try to track the market and fine-tune what could be the possible move in next few hours. But still, we try to use the trading strategy to limit the risk and maximize the profit and also consistently earn from the market. So this webinar I give once in a month, and it happens so that today I was giving the Asian session live market analysis on Thursday. What I give on Monday, the forecast for the entire week, I review it on Thursday. And on 11th of August, I gave the webinar and also the expected market moves for this particular week. And today, during that of the Japanese session, I just reviewed the forecast, how far they have made the drop in the case of Euro and GBP, in line with that of the expectations of the market. And there was also a remark during that time that I'm the only person who has been suggesting that there will be a drop in the case of Euro and GBP, and most of the analysts were expecting the reversal in the market. Now, let us go into that of the expected market moves of today as a broad outline for us to take the trading decisions. Now, today they are expected to make the swing and drop move during the Japanese session. But they did not make a drop, but they only made a dip in the case of Euro and GBP. And I'll refer to that of the initial lows and the highs, then you'll be able to understand. Then they are expected to make a small swing and form up move during the European session, and then swing and drop during that of the US session. This is the expected market move. So we are now 30 minutes past the start of the European session. European session starts by 7:30 GMT, and 8 GMT we are in, and it is 30 minutes past the start of the European session. Then when you look into that of the live market page, and also the initial lows and the highs, what we note down by 3:30 GMT on a daily basis, and try to compare it with that of the current market condition, we'll be able to see what sort of moves they are doing it. Now, these are all the levels there in the case of the initial lows and the initial highs, noted down in the 4 majors and 2 commodity pairs. Now, in the case of Euro, 1.3356 is the initial low, but they breached it and came down to 1.3349. And the high was 1.3367, but they made a brief upward stop trend. And during the gap time, they just made a brief upward stop trend in the case of Euro to 1.3367. Above that, by 3 pips, start coming down. And now it is holding exactly around the initial low. Now, 30 minutes past that of the European session, they are holding around that of the initial low. Anybody who has taken the sell position above that will be still in profit. You can keep stop at entry. So automatically, those who have taken long position, slightly higher level, they are in the negative condition, and they could go in for the long liquidation during the slide. And in the case of GBP, which is more evidential, and the initial low was 1.6670. They just breached it by about 12 pips. 1.6658 has become the new low, and 1.6692 is the high. They have not breached the high, which indicates that they just breached the initial low, 1.6670, and GBP is still staying below that of 1.6670. When it stays below that of the initial low for more than 30 minutes, that means they intend to make the slide further down. It is not a stop and it is actually a slow intentional move on the downside. So that I will explain it when I take up the type of moves what you come across. In the case of yen, for 30 minutes they are not breached the low, but it came down close to that of the initial low 102.40, and people thought that there could be further drop, but they did not breach the low, started gaining the levels. So we can do a buy and sell trade. So in the case of USD yen, we can do a buy and sell trade. In the case of Euro and GBP, we can sell below that of the initial low and close it during further drop as a technical trade. Then in the case of CHF, 90.74 was the initial high low, 94.84 was the initial high. They just breached the high by 2 pips and came down, and the low was also breached 90.68 and then come above that of the initial low. 90.74 is the initial low, but they just gained to 90.76. So they just made a brief upward stop and then a downward stop and then reversed to gain again in the case of USD CHF. Then in the case of Canadian dollar, 1.0913 is the low they set during that of the Japanese session by 3:30 GMT. They made a downward stop and which came to 1.0908 and still holding below that of 1.0913. The high is 1.0921, but they are not breached it. So when they hold below that of the initial low, then we expect further drop in the case of USD CAD. Then in the case of Australian dollar, 92.88 is the low, 93.10 is the high. They are not breached the low or the high. So that means they are making a narrow range swing from that of 330 till now, and they did not make any upward stop or a downward stop. So they are holding certain currencies like New Zealand dollar, Australian dollar, and make moves in other currencies so that you find that crosses of such currencies are being handled at the given time. So what we understand in the case of Euro, now they just come above that of the initial high, initial low, 1.3356, and if they stay till 8:30 GMT above 33.56, then they will slowly gain the levels. But they just made the upward stop, and so till end of the session, they will not make again a further rise because they made an upward stop and made the drop and made the downward move below that and holding around that of the initial low. But there is a clear-cut evidence that GBP, they just cut the initial low and stay below there for more than 30 minutes from that of 7:30 GMT. So they are likely to make further drop. And also in the case of USD, they are likely to gain. So having understood by making the market trading technique, we will go in for the position taking. So for that, what we do, first of all, we find out from that of the derived forecast what could happen during the session. But during the day, they are expected to make the drop. So in line with that of the expectations, we'll try to take the trade. And also we have done the market reading by comparing the current market levels with that of the initial lows and the highs set around 3:30 GMT. And then we find that if it is near that of the high, we can take a sell. Not breach the high for more than 30 minutes, we can take a sell. If it is near that of the low and not breach the low for more than 30 minutes from the start of the session, we can take a buy. But they breached the initial low and formed the new low, and they are swinging between the new low and the initial low. If we are able to understand, in such a scenario, then they are expected to or likely to come down further as you find slow swings are there, which is an intentional move. Then still, even though we have done the market reading by making the comparison with that of the current market condition with that of the initial lows and the highs set around 3:30 GMT, still we do not take a chance. So what we do is we use the trading strategy. That is, we keep 30 pips away from that of the position, the entry stop, or for the sell position, a buy stop as a hedge. And for a buy position, we keep a sell stop as the hedge. In the MetaTrader platform, you come across such order formation, and they are all nothing but the hedging orders. So now we are in the European session. The current time is 8:12 GMT. So you can see that 7:30 the session starts, and 8:12 it is the early session, and they are not breached the initial. And we have seen that they have breached the initial low in the case of Euro and GBP and come down. But whereas in the case of USD Yen, they come closer to that of the initial low, but they are not breached. Then what the trading strategy I explained. So these are all the type of moves I'll explain to you afterwards, and also about the hedging. So we'll try to take the positions now. So Euro will wait whether they are going to hold for 30 minutes above that of the initial low, 1.3356 for 30 minutes. In that case, we'll try to take a buy. But in the case of GBP, we'll definitely take a sell position. $1.6661 because 63 no, because it is below that of the initial low 1.6670. So we take a sell position below that of the initial low when they are holding below that of the initial low for more than 30 minutes from the start of the session. Okay, that is the method we have to follow. Then we'll be able to see that how exactly we are able to take appropriate trading decision. Even though now GBP is slightly making a firming up move of one tip, it may give that impression that we can buy, but no, we will be able to realize it by end of the session. Then we have to keep the hedge order, because whatever studies we have done it, and the element of error should not make us to lose the money. So we do not take a chance for a more unlimited condition. So we only take the risk only for 30 pips. So when you take a sell position, 1.663, then we will take, we will keep a buy stop order. It's an order. It's not the position, it's only an order. 30 pips above that of the entry. So 30 pips above that of the entry. Then as I told you that USDN will try to take a buy position. The buy position is 102.45, the current market level, because for 30 minutes from the start of the session, they are not breached the initial low. 102.40, they are not gone below that, and they are expected to come up and breach the high, because they are making an intentional move on the upside, which is also in line with the other currencies. All are trying to do the USD gaining move. Then we try to keep the hedge order. The sell stop order, 30 pips below, it will be 102.15. Then CHF, they just cut the initial low and come above that of the initial low. You can try to take USD CHF. Buy position 0.9076. With the sell stop. For a buy position, we have to keep a sell stop as the order to limit the risk to only 30 pips. $90.46. Now, the initial low in the case of euro was 1.3356. They are simply holding around that and they are not gaining it. And for 15 minutes or 17 minutes over, still they are not gone. So we will take euro USD as sell position. $1.3356 with it. Buy stop. $1.3396. In the case of Australian dollar, they are not just breached the low or the high till 30 minutes. Now they just made a brief upward move to 93.12 and come to that of the initial high 93.10. So we'll take an Aussie a sell position. With a buy stop, $93.40. Okay. So they are making a nominal swing, but as we are able to see that they are simply holding it and making small swings. And later on, in the meantime, we'll try to see the other components of this particular trading decision. Now, as I told you, for taking the trading decision, we need the three components, namely the derived forecast, then fine-tune the forecast using the market reading. Then still we are not satisfied with the trading decision, so we try to use the trading strategy. In the event if the forecast goes wrong, we will not simply say that, no, my forecast has got an accuracy of 70% or 80%. So in the event the trade goes, then 20% of the trades I will lose. Why not you fine-tune it? Why not you see that we don't lose money in any of the trades for that matter? So that is possible if you use the trading strategy with a simple concept. Either the market has to go up or come down. It cannot stay in a place, or it cannot continue to rise, or it cannot continuously drop. So alternatively, we'll be able to get the profit, whether you have a buy position or the sell position, if you develop an appropriate trading strategy. So when you use the hedging, in the event if the hedge is filled, then we hold one buy as well as a sell position and view the buy position as a trader who has got a buy position and view the sell position as a trader who has got a separate sell position. Then we act accordingly. Thereby, we develop the trading strategies innovatively and try to earn profit in all the trades. Now, for that, we need to understand the timings followed by that of the players. These are all the timings followed by that of the player and on a daily basis. So you need to thoroughly remember this. Even though in the market we have been guided with regard to the Asian time, the London time, UK time, or European time, New York time, US time, Pacific time, etc. They are not to be followed. If you want to understand the intentions of the players, we need to follow the timing followed by that of the players. Since it is 24 hours market, the players follow the market using the GMT time frame. So try to see that the live market code page in which we are holding the GMT time frame. On this live market code page here, it is 4 hours behind the GMT, that is New York time. They said it. And anyhow, we can just use the GMT time frame obtained from FX Trade on the home page. You can just find out how exactly during different times of the day they are making different moves. So now we find that they are just making small swings here in the market, and we have the hedging order to limit the risk. In the event if we are wrong, we will be able to book profit on the hedge side as well as the book profit on the sell side during the year session. So we have got the broad outline of the forecast. So we are not really afraid in taking the entry position because we have effective trading strategy. Now, we need to understand how exactly they are making the moves in the market. See, the players have to move all the currencies. In order to move all the currencies, they just mainly move the majors and the two commodity pairs. Even though it appears in the market that the crosses invariably influence the moves in the case of the majors, but it is other way about, because when the financial institutions and others, when they wanted to misguide the traders and induce them to lose the money, invariably they have to give an opposite interpretation. So in that process, they say that because the crosses have influenced and because of the majors have done the moves, but actually they make the moves in the case of the majors, especially the four majors and the two commodity pairs, and bring in the moves in all the respective process. So by making the contrarian move, for example, a typical contrarian move, you can see that GBP is showing negative net change and USD CAD, CHF is showing negative net change. So that when both show negative net change, they push down GBP CHF on the negative side. GBP CHF, they just pushed it down in order to make a stop and before making the rise. So we need to understand how they are pushing the currencies with the help of the net changes. Then we'll be able to really understand that they are using the majors to bring in the changes in the currencies and not other ways about. Then here we come across the net change, and that is nothing but how far the currency has moved from the previous day close. For example, euro, from the yesterday close, it has just moved only 5 pips lower. And in the case of GBP, it has moved down 15 pips from the yesterday US session close. And that is how we understand. In the case of Australian dollar, they gained about 4 pips from the yesterday's close. So the time has passed, and nearly 8 hours and 30 minutes have passed from the start of the day, but they have not made any significant move in the market. Only hardly all the currencies are making the moves of less than 10 pips, excepting GBP. So you can understand the market volume has come down. In such a scenario, we should be able to develop an appropriate trading strategy and try to see that we are able to book profit. And still, we should avoid over trading, because many of the traders develop the tendency when the market is range bound, they increase the lot size in order to earn more. So instead of one lot, if they may take about 5-6 lots, thinking that there may not be much of a pullback. And once the market shows some profit, they will just close it with a profit like a scalping. But suddenly, like yesterday, how they have made the extended stop and move. That is, they quickly gained in the case of GBP from that of 68 level to 68.42 and then dropped it to 67 level and further dropped in the case of GBP. That is called the extended stop and move during that of the trend reversal time. So they just made it in the case of GBP, and now GBP is continuously making more loss when compared to other currencies. By dropping GBP more and more, they will bring suddenly the bearish feel in the market by next week and the following week. Normally, the trend reversal they make only during that of the month-end time and the new month beginning time, not any time of you imagine. So till end of this month, they are expected to make the drop in the case of Euro and GBP, and don't be in a hurry to try to catch up the falling knife. And it is nothing to do with the economic conditions of Europe or conditions of any of the currencies or the respective countries like European economy or Great Britain economy. And the players can make such moves telling so many excuses. Simply, they may say that risk aversion, everybody is wanting to buy US dollar, which is the heaven in the market. And so suddenly they can say that no, European economy is very bad, so simply drop euro. Or simply they can choose yen as a safe haven currency and try to drop it, USD, and they can drop it. Or Swiss franc, once they dropped it like that to an extreme level, telling that it is a safe haven. So they can give different stories for the type of moves, what they are doing it. Ultimately, they are all nothing but the excuses. So understand, the excuses do not become the reasons, because they know very well such excuses will give a soothing effect for the traders, so that the traders won't suspect the players. That's what they want. And if even I openly talk about the players, and they know very well that one day or the other, the traders will come to know about it. And also in the close circles, in the banks and other places, they know very well how the market is being manipulated. The only thing is they are tight-lipped, they don't open. And those who got retirement from that of the deal rooms, etc., they talk a little bit about stop hunting and they talk a little bit about the other aspect, but still they don't disclose the truth because of the laws. So ultimately, indirectly, we try to protect the players. It is a very unfortunate situation. And in the financial market, you find the cunningness is being renamed as smartness. No? Actually, in the financial market, you find the people try to misguide others and try to earn, which is nothing but the cunningness. And by using the cunningness, they try to earn, give the bullish feel to the traders and take a buy position afterwards, they drop. It's nothing but the cunningness. But they call it as smartness, the smart way of making money. So if you use the live market code page, then you will be able to really understand that how pip by pip they make the moves in the market and what they are trying to do in a given time, we will be able to understand. Then what is important is by looking at the live market code page, we should be able to determine what move they are trying to do it. Now, you should broadly classify it into three categories: the type of moves, what they are doing in relation to the time factor. A move they do during start and the early and the late sessions, which is called the stop end. They do the stop end above that of the high or below that of the low. That is the initial lows and the highs. So in the case of Euro, I told you that they had done the stop end above that of the high as well as below that of the low, and holding closer to that of the initial low. So a stop end is a move which happens in less than 30 minutes. They make about 15 to 25 pips up or a down move, sometimes 2-3 pips also. The volume is less, or if they are on the downside trend, they don't gain more and make an upward stop. And why? Because if they rise and those who have taken the buy position will book profit, then when they drop, they will not come for long liquidation. So they are very, very clever in that way. So they drop about 70, 80 pips, gain about 10 pips, so that nobody is in a position to book profit. After dropping to 66.58 or 66.75 yesterday, they gained it to 66.92 and started making the drop and gain about 10, 15 pips and then drop. So that any level you buy, if you don't accept the profit of 5, 10, 15 pips, then it will make loss. That is how they try to make the moves in the market. And then later on, everybody is induced to liquidate the long positions. So for that, they use the stop point on the upside before making a drop so that nobody is holding the sell position to book profit. Predominant of the short sellers, if the stop is close by, the stop will be hit before the drop. The false move is the one they just go up to that of the high and reverse without breaching the high, or up to that of the low and reverse. So in the case of USD yen, they did the false move. So you know that at the start of the European session, it was around 102.50 USD yen. Then they came down and down to that of 102.0, 102.42. Without breaching the low, they have come above for 30 minutes. And now it is 1 hour from 7:30 to 8:30 GMT. 1 hour they are not breached it. Even though it is close to that 102.42, you can watch till the end of this session whether they are breaching the low or not. Then you will be able to understand how they are making these moves very meticulously. It's not a random move. Then they make a quick move. These two are quick moves. Similarly, the next type of move is called the extended move, which happens for more than 30 minutes up to 2 hours. And that is called an extended move. What they do is they breach the high and stay above there for more than 30 minutes and hold above that of the initial high up to 2 hours and reverse. Always the extended move will be alternated with that of the intentional move. If their intention is to drop, yesterday you would have noticed that intention is to drop GBP, but they quickly gained the levels above that of the initial high, stayed there, and after the speech started making the drop. That is an extended move, a quick rise, which will give that impression to the traders that GBP is going to rise further up. And later on, they really make a drop. So that is called the extended move, alternate with the intentional move. And the intentional move, in that what they had done it, extended stop and they had done it. That happens only during that of the trend reversal time. So extended stop and is a one which happens for more than 30 minutes, but still it is a stop and. That is why it is called as extended stop and. They just breach the high and quickly go about 50, 60 pips, sometimes 100 pips if the volume is good, and then drop, and breach the low and go below and drop about 200 pips. I have seen days wherein they gained 100 pips and dropped 200 pips. Nowadays, hardly come across 5, 10 pips or 40 pips rise and 100 pips drop and things like that. But those who have been in the market for a long time, they know how during the trend reversal time, they make such extended stop and moves. So always the extended move, stop ends or a false move, they are all quick moves. And the only move which is slow, pip by pip, is the intentional move. And in between time, that is during the mid-session, they try to make a move which is called a swing. So intentional move will be a pip by pip move. Slowly they will cut the low or slowly they will cut the high every 30 minutes and go. They may cut the high and go above. Every 30 minutes cut the high and go above. Or every 30 minutes cut the initial low and go below. So initial low, then further new low and further new low and go below. So that is how they make the moves. So when they make such moves, we need to understand that it is for 2 sessions and the start of the 3rd session. So till such time, they will try to make the moves, but they will not continuously drop. So what they do is, see now the European session start, they breach the low and they stayed below that of the initial low and come above that of the initial low briefly. Exactly before the 30 minutes getting over, they came down and again they pretend as if it is going to go up, and slowly they will start making the slide and using the data release or any other information or some rumor or some other events they can, or a message, they can use it as a trigger, and simply a speech can be used as a trigger and start making the slide. Okay, this way they just make a slow slide below that of the initial low and come up to that of the initial low, not breach and stay there for more than 30 minutes and come down, then again breach the low and then go up during the start of the year session and go closer to that of the initial low and start making the slide. So that is how they do it. So we need to understand it will happen for 2 sessions and the start of the 3rd session. Now they started the intentional move during European session. So it will continue till the of the US session and tomorrow Japanese session. So till this time they intend to make the slide. So we'll watch how exactly they are doing it. And in the process, US dollar is gaining. So I don't have any affinities to any of those currencies. And many of the people might be thinking that I'm favorable to US dollar. That is why I'm expecting Euro and GBP to correct. But if about 3-4 months back, if you listen to any of my webinars, you'll know that I was recommending everybody to buy Euro and GBP because they are expected to gain the levels. And they went up. Afterwards, they are expected to make that drop. We have to accept and we have to see how the players are making such moves. And we should not become sentimentally associated with that of the currencies. When Euro becomes weak, some people start crying why Euro is becoming weak and things like that, because they develop the bullish feel and try to call themselves, I am a Euro bull, and assume themselves that they are Euro bulls and they only want Euro to go up endlessly. And these are all nothing but the emotional attachment. But we have to understand basically that they are all tradable instruments. It is not a physical currency, Euro. It is only a ratio between Euro and USD. And this ratio is a tradable ratio. And in that we get the leverage and with which we are trading. So we have to understand the reality, because many people talk in terms of Euro instead of calling it as a Euro USD and dollar yen, and then you come across the sterling and cable and things like that. So Swissy. So when the nicknames are used, invariably you find we develop some sort of attachment similar to that of people who are associated with the animals with their pet names. So we also try to give the pet names for these currencies without our knowledge, develop some sort of affinity towards those currencies and fail to understand that they are only tradable. We can do buy and sell as well as sell and buy trades. But when Euro and GBP on the downtrend, then such people who have developed the feel, they hesitate taking the sell position. They want the pullback to happen afterwards. They take the sell position, and the pullback does not happen when they breach the low and stay below the low for more than 30 minutes. So this is what mainly inducing the traders to become spellbound, and they are not in a position to understand the market moves. So if you have the emotional attachment and look into the market, then you find it is extremely difficult. Now, the next important thing is the trading strategy. So as soon as we take the position 30 pips above or away, we keep the hedge order, because the hedge order is to limit the risk. The players are capable of quickly drop and quickly gain the levels in the market, and they can also bring in the moves in such a way that can be very, very quick, and the platform may not fill our orders. So during the data release time, for example, And suppose you have got a sell position in euro and suddenly they gain about 50 pips and you want to close the position, the platform will not allow and it will simply reject your order. They will say appropriate fill is not available. And then subsequently they make one big rise. And then if you place an order, immediately the order will be grabbed by the platform and they fill it. And later on you find the market comes down. So, but if you place the order beforehand, at least you can fight with your platform provider that I placed an order and you did not fill it and it is wrong. And you have to give a definite fill. That is an agreement. And so you can ask them to give the compensation. And many of the honest platforms, they give the compensation to the traders that they give a wrong fill. And some of the platforms, they simply say, give some excuses and they don't part with any money and simply say that that is how the market is. Okay? So you find that when such moves happen, invariably when a huge loss has to be accepted forcibly, then you find that you are really badly hit. And when the equity comes down, then you become very defensive while taking the next position. So invariably what happens that you fail to use the trading strategy. And the trading strategy is a must. And without that, you will not be able to trade at all because the market moves are very volatile and very big. And in the trading strategy, the simplest trading strategy one follows is using the stop. But what happens when you use stop, the players hit your stop very frequently. When you keep 30 pip stop, and occasionally they hit it. When you keep about 10 to 12 pip stop, in order to avoid the loss, then they hit the stop very quickly. And if 30 pip stop is hit, then you think that, okay, I'm incurring 30 pip loss. Instead, I'll increase it to 70 or 80 pip stop so that there is unlikely chance that they will hit. Or I will keep the stop for a sell position above that of the resistance so that they will not hit my stop. But the players can see the cluster of stops where they are placed and they can make one big quick rise and hit all the stops like how they had done it yesterday in GBP and start making the slide. So you won't be holding the position even though you assumed or you thought very clearly or very correctly that GBP has to fall, but you are stopped out. So invariably, what do you think that it is better to trade without a stop? That is how predominant of the traders go in for a trade without a stop. It is not that their intention is to take unlimited risk. They find practically these are all the problems. So keep adequate equity and trade without a stop. But instead, you can keep an optimal equity and try to keep hedging order. Once you keep the hedge order, what happens? If the position is hedged, how exactly I can handle the hedge? So that is the only challenge. If I handle the hedge appropriately, then I'll be able to earn. And in the market, you find, suppose somebody has got a sell position. There are others who have got a buy position. Okay? Both the type of positions are taken by the traders during different occasions and during different market hours, depending upon the market sentiment. So everybody will be thinking that they will book profit. So there will be an opportunity for the long holders to book profit. There will be an opportunity for the short sellers to book profit. But the only thing is, when quick drop happens, the long holders cut the position and turn short after the drop. And the short sellers book profit and think that the market may not reverse and take further sell. Then what happens? The buyers buy all the sells and take up the market. And a person who has taken the higher level buy feels that, oh, I could have held the position, I would have booked profit on the upside. So this is what happens on a daily basis. So if you use the hedging order, what happens? If it is hedged, you watch for 10 to 30 minutes. And during the watching, if the hedging is not making profit, that means the hedging was filled during a stop and move. So that is why they are not giving the profit booking opportunity. So in such a situation, close the hedge position with 1 or 2 pips loss or with stop at entry, keep another hedge order. 15, 20 pips above that market. And when they start making the slide, you lower down the hedge order. So that way, we can just handle the hedging by looking into the time taken for the hedge to show profit and the loss. In the event, if the hedge is making profit, that means the market is going against me. Thank God that I have blocked only 30 pips. So if the market goes about 300 pips against me, it doesn't matter. I can simply close my sell position with 30 pips accepted loss. Or if I have the feel that market has to come down, then when the market goes up, I'll use the trailing stop in the hedge and continue to trail it upward. And once they stop cutting the new high and beyond that, they are not rising it for 30 minutes, I just book profit on the sell side, buy side. Then keep another hedge order above and let them rise and hit, as it doesn't matter. If they go further up, I will try to book profit on the hedge side. Otherwise, the hedge is not making profit. I'll just close it and keep another hedge order and trail it down. Once they start dropping, and when the market continues to drop lower and lower, my buy position will make profit, and I can close the buy position as well with a profit. So you can do either way trades using hedging. Or you do not want to take any risk. So when the market is rising and the hedging is making profit, keep stop at entry. Let them rise about 100 pips. Doesn't matter. Suddenly when they drew us and close, you are hedging with stop at entry and continue to drop, you are in the money on the sell side. So we can think of various trading options if the hedging is used. And that is the main reason that the experts just curtailed hedging for that of the US clients. They thought that the US clients might make money and they may not lose money in the market. And it is very difficult for the banks to make money. So they said that if you use hedging, you do not know trading. See, when they bluntly say that, then the traders, a beginner, will think that, oh, yeah, if I use hedging, that I do not know how to trade. So I should be able to know which way the market has to move and then take position. Okay, now I have to see whether euro has to go up or come down. Then how do I identify? Use the technical analysis and do it. And take the position, fine. It comes down about 2 pips and later on rises about 30 pips, I stop. And in case if I average it, no, that is not possible. The first position, what you have taken, you have to close first. So they put all the restriction telling that you do not know how to trade. No, this is the unfortunate situation. And these are all nothing but market making. No, they push the traders, those who have got the urge to trade, urge to earn money, or they have got the compulsion to earn money because they have got a huge debt. And they push all of them in a den. And later on, they put so many conditions. And okay, now you can earn. These are all the conditions. Okay, otherwise, these are all extra conditions for you. Then you try to trade and do it. They become fatigued and lose the money. In the process, what happened? Predominant of the traders have left the market. And now to move 1 pip, they take about half an hour to 1 hour. It is something like Midas wanted to see that everything becomes gold. It is Midas touch. And that is what we come across in the market now. So we'll come into that of the trading strategies or our current positions. So in the case of CHF, we took a sell buy position and which is making a slight loss and it has come up to the low. And in the case of GBP, it has gained about 7-8 pips higher against us. And in the case of yen, it is about 1 or 2 pips against us. And in the case of euro, it is about 5, 6, 9 pips against us. And in the case of Australian dollar, it's almost at the same level. So I will try to show what happened to these positions. If the market goes against me, I got the hedge order to limit the risk. If the hedge is filled, then I know how to handle it after watching for 30 minutes the market. The hedging is making profit, I'll keep stop at entry. The hedging is making loss consistently for 30 minutes, I will close it. That means that they filled my hedge only during stop and that is not their intention to fill my hedge. Then I will try to wait for them to, I will try to close the hedge and keep another hedge order. And then once they make the move in my favor, I'll keep stop at entry in my original position. So that way, a simple trading strategy we use using the hedging tool. And if the trading platform does not offer the hedging facility, then it is difficult. We have to use the hedging in corresponding pair. Suppose you have got a Euro USD as the sell position and you wanted to keep the hedge. And what you have to do is you have to choose a currency which is also making similar net change against, instead of US dollar, against some other currency, and which should be making a similar net change level in the same direction. Only then you will be able to take the appropriate position. So Euro Yen, if you see it is making one positive net change, then probably you can use Euro Yen as the hedge today. But tomorrow it may be different. And Euro GBP we can use today, but not otherwise, because it is also making positive net change. Why? We have to use the same currency wherein the euro has to be a numerator. The denominator can be another currency. For example, Euro CHF. Euro CHF, it has made about 5 pips negative net change when euro has made only, euro is also making negative net change. So this is not a wrong, that is a wrong hedging. Because if you keep there, you take a sell position and keep a buy order, hedge order, and that hedge is filled. In that case, we try to take a buy in the case of Euro CHF, and that also drops, then you will make further loss in the other hedge position. So actually the hedging is the one, and you should be making profit when the market moves against you. If you use it in the same currency, then it is the best method to use the hedging effectively. And you know that for the many of the institutions, the banks might recommend with regard to the forward cover, etc. And in the forward cover, they misguide many of the traders and many of the institutions. And in the process, the institutions or the exporters and the importers, they lose quite a lot of money and the banks earn. That is why the banks become richer and richer all the time. And, you know, many of the people out of ignorance, they simply believe others. And in that process, they find later on they lost huge money. So ultimately, what my simple advice is, don't even trust me. Best thing is you assimilate or collect informations as much as possible. Try to find which is making sense, which is relevant to that of the market condition, which is suitable for your trading, and then you try to develop your own system and adapt it. You will be able to really make money. Just because somebody has said in the name of, by the glorified name as an expert, it doesn't mean that the market has to move in expectations of the experts. The experts can only assume scientifically, and the market does not behave scientifically. That is an unfortunate situation because it is manipulated. The Guggenheim has got a question. I am trying to answer to the questions as much as possible now. How about spread between low and the high? Yeah, the spread between the low and the high should be more than 40 pips in order to initiate a position. But even though the spread was not there, I had taken the position because I expect them to make the drop today to make profit on that. Otherwise, we can commit positions when the spread becomes high and the low is more than 40 pips. But now you find that only during US session, they increase the spread to 40 pips between the low and the high because of the low volume condition. Then what are your approximate target? Is it 1:1? I'm not able to understand Himanshu saw the question. Approximate target is 1:1. Okay, we are talking about 30 pips hedge order means 30 pips profit. I explained it that the profit can be 45 pips or 75 pips. I have not kept the exit level there because depending upon the momentum, we can keep the exit level. Otherwise, you can keep 30 pips, which will get filled easily. Yeah, I will show the slide. Then I did not came late. Sorry. Okay, GB back above initial low. It is downward stopping. No, not at all, sir. They wanted to pretend as if it is going to go up, but they wanted to make the slide. It is at this time. Any retracement in cable expected subsequent to yesterday's? No, sir, not at all. After the extended upward stop, and they will continue to make the slide. Swing and slide, swing and slide. In MRC, how the change in euro is +1 in 36.65. When it goes above that of yesterday's closed level is 4 pips above this. So 1.3364, that's what it indicates. Now it has come to 1.3360, then it is 3 pips negative net change. When it gains 4 pips, it will become +1. That is how the net change shows whether the market is above that of yesterday's close level or below that of yesterday's close level. The MRC, numerator and the denominator. Numerator wherein the other major is the numerator of ratio. Euro, USD. Euro is the numerator, USD is the denominator. No, in a ratio, we call it as a numerator on the upside and the denominator on the downside. Instead of one below the other, we find a slash in between. That is how the ratio is calculated. These are all nothing but the ratios. And now USD-Yen. In that, USD is the numerator and the denominator is the other major, Yen. So when Yen is a denominator, it is a denominator currency. CHF is a denominator currency. Canadian dollar is a denominator currency. That is how the players use it. So I wanted to use the same terms so that you will be able to really understand. The numerators, Euro, GBP, and Australian dollar are the numerator currencies. Then Himanshu, risk. Okay, the risk reward ratio is 1:1. You can maximize the profit. When I give the trade call like this, you can keep stop at entry and use the trailing stop of 15 pips away from the market and keep a trailing limit order. You need not keep that limit order as a fixed order. You can make it as a trailing limit order. The provision is available in the trading platform so that when the market continues to drop and the orders will not be filled. And like yesterday, GBP quick drop, the order will not be filled. The take profit order will also move down. And suddenly when reverse, it will get filled. So that way you will be able to maximize the profit. The provisions are available in the trading platform, but many of the traders do not know how to use them because nobody teaches the traders in the right way. And everybody says that you take about 10 lots, the leverage is 1:500, you commit so that you will be able to easily earn and give less money and take more profit. But actually you find later on that when you take about 5 lots also, the usable margin is not coming down. You take 10 lots, 15 lots, later on find when the market goes against all the position, make loss and you lose. And the platform provider simply laugh at you and simply tell you that you should not trade like that, pump in more money and take less position. That is how they will do and induce you to pump in more money, and they will take away all the money. When can we buy USD CAD? USD CAD, you can just, they just breach the initial low, come below. And whenever you wanted to commit positions in the case of majors, the early session and the late sessions are ideal. So now we have to wait till that of the late session. The late session is from session timing. I'll show you. Okay. This the 11:30 to 13 GMT is the late European session. At the time, you can take a buy when they stop cutting the new low for more than 30 minutes. And then later on, you will find your session after the data release, they will try to gain the levels. Before the 12:30, there is a data release. So that will also happen during the late European. At that time, when they make a drop, you try to take buy positions. Probably they might go below the psychological level to hit the stops below 1.09 and later on come up. So always you try to commit positions whenever the peak move happen, either during the early or the late sessions. Okay. Now, so as I started from 8 GMT, so we'll try to complete it by 8:45 GMT. So we have another 3 minutes to go. So I'll just rush up with regard to the slide. So to track the market, we need three components, namely the derived forecast, the market reading, and the trading strategy. And ultimately, we focus more on the trading strategy rather than that of the forecast or that of the market reading, because these are all nothing but the speculations, either a scientific speculation or a gut feel or whatever it is. And ultimately, we should see that we don't lose money in our trades. And if somebody recommends a trade and it is about 70% profitable, it doesn't mean that consistently you'll be able to make 70% profit in all the trades. And if you commit more positions during the 30% wrong trades, you can lose more. So ultimately, the trading strategy is vital. So when you use the trading strategy, when you don't find the trading is going good, then automatically the hedging should be able to limit the risk. And if the going is good, after keeping stop at entry, you find that you are able to maximize the profit without the market fear. So for these two, you really require the trading strategy. And also we have to understand what is the domain of that particular market. So it is a 24 hours market. So all the 24 hours, they have to make the swings. And there are different banks opening and closing. They have got the local timings, etc. for their opening and closing. And the treasuries work 24 hours for the trading, and the treasuries work for the exporters and importer currency conversions during specified period. So how exactly they incorporate all those times in that of the market moves. So that is what the session timings are. So these are all the session timings followed by that of the players. And if you want to understand or read their intentions, you need to follow the same timings. Then you find, okay, exactly 7:30, they make quick moves. Exactly 13:30, they are making quick moves. And during the gap time, they make a false move. They rise, and the first 30 minutes, they drop. If they drop during the early gap time, and they rise during first 30 minutes, you find systematically it happens most of the time. That means we need to read their intentions following their market moves. And for that, we try to identify the type of moves they are doing it. And with the help, we find out quick moves are false moves in the market, and slow moves are the intentional move. Only the intentional move for 2 sessions on the start of the session, third session is the slow move. Rest of the moves are all quick moves. All quick moves are false moves. And that means they quickly gain in order to drop, hit the stop, and then drop. They quickly drop and hit the stop in order to gain. So people may simply say that it is a contra trade or a counter trade. And it is not simply counter trade, because we have to wait for 30 minutes. And when they stop cutting the new low for more than 30 minutes, then you will take a buy. When they stop cutting the new high for more than 30 minutes, you can take a sell. If they cut, then you have to wait for 2 hours, where it might be an extended move. If they cut after 2 hours, that it might be an intentional move. Then you should not buy for 2 sessions on the start of the third session. That is how we should be able to differentiate based on the type of moves they are doing into the market. Then in the event, if they go against you on the hedge, then You watch for 10 and 30 minutes. And the hedging is not making profit, close it. The hedging is making profit. That means they are going against you, and keep stop at entry. Let them go against you even 300 pips. On certain other time, they will come down. At the time, you can book profit. Otherwise, let them go upward. I will also capitalize it by booking profit on the buy side. Later on, when they drop, before that, I'll take another sell, and both the sells I'll book profit. So you can develop innumerable trading strategies by that method. If you use the hedging, but you have to be creative. And how you can be creative? Only if the market fear goes, then you become creative. So there are various information available in the market, and they are all mainly to trigger your fear. So avoid listening to all those things. You focus only on the live market code page and try to see how the price action is happening, and only use the data release time as a market trigger time. You find that you are able to consistently earn money from the market. So I'll come back by putting GMT during the early US session, 30 minutes from the start of the US session, and then try to give the market comparison with that of the initial lows and the highs during the early US session, and also try to find out what happened to the positions, what I have committed during the European session, whether they are in profit or hedged, all those explanations I'll give it, and also give the new trading proposals for that of the US session. So if you find this method is working for you, and try to do it in a demo trading platform, and find that consistently you are able to earn money irrespective of the market condition, then try to put it in your real trading. Thank you one and all. See you after about 6 hours by 14 GMT. I take this opportunity to thank FX Trade for the facilities provided. I thankful to you.